Welcome to Motivated Life Coach by Nilesh Modi. Today we are going to know what are mutual funds and shall we invest in mutual funds or not. Before starting, please don't forget to like, comment, share and subscribe to our YouTube channel as we are going to bring a series on mutual funds for you. So let's get started. Mutual fund starts with investors. Investors are people like us who save money to invest in financial instruments. When a group of investors invest their money in AMCs, which is asset management company, the fund managers of the AMCs invest our money in securities. Securities are bonds, stocks, mutual funds, ETFs, derivatives and hedge funds. So when a fund manager invests in securities, it generates returns and the same returns are passed back to the investors. In short, mutual fund is nothing but where an investor puts his money into a fund house. The fund house is investing the money in the securities. Securities generate the returns and returns are passed back to the investors. That's how the mutual fund industry operates. Let us first understand a brief history of mutual funds in India. The mutual fund industry in India started in 1963 with formation of UTI in 1963 by an act of parliament with an initial capital of rupees just 5 crores. This amount was contributed by RBI, LIC, SBI and its subsidiaries and few scheduled banks and financial institutions. In 1978, UTI was dealing from the RBI and the Industrial Development Bank of India, which is in short known as IDBI, took over the regulatory and administrative control in place of RBI. Unit Scheme 1964 was the first scheme launched by UTI. At the end of 1988, UTI had rupees 6,700 crores of asset under management. The number of investor folios has gone up from 5.28 crores as on December 2016 to 12.02 crores as on December 2021, which is more than twofold increase in a span of just 5 years. On an average, 11.23 lakh new folios are added every month in the last 5 years since December 2016. Mutual funds are of two types, active funds and passive funds. Active funds are again of three types, equity, debt and hybrid, whereas passive fund has got only one type, which is index. Okay. The aim of the fund manager of an active mutual fund is to generate returns higher than the returns of the benchmark index, and hence he actively manages the fund by taking proactive decisions to buy or sell a particular stock depending on stock market conditions and the fundamental attributes of the stock. Okay. Passive funds mimic the indices created by NSE or BSE and do not have any active role of the fund manager. Equity funds invest predominantly in shares or stocks of companies. They are also known as growth funds. Debt funds invest in fixed income instruments such as corporate and government bonds, corporate debt securities, and money market instruments that offer capital appreciation. Debt funds are also referred to as fixed income funds or bond funds. Hybrid funds invest in a mix of different asset classes to diversify the portfolio with an aim to minimize the risk involved. Hybrid funds have the potential to generate relatively better returns than debt funds while being less riskier than the equity funds. Index funds are passive mutual funds that mimic popular market indices. The fund manager simply invests in all the stocks that make up the index to be followed. Okay, let's see the categorization of companies as per SEBI. SEBI has classified companies into three different categories based on market capitalization. According to SEBI, the top 100 companies are categorized as large cap companies, and mutual funds that invest in stocks of these large cap companies are categorized as large cap funds who have a market cap of around 20,000 crore or more. Companies that rank from 201 to 250th position in terms of market capitalization are known as mid-cap companies, and their market cap generally tend to range from 5,000 crore to 20,000 crores. Whereas companies that are ranked from 251st position onwards in terms of market cap are automatically categorized as small cap companies. Small cap companies generally come in below rupees 5,000 crores. Let us understand debt funds now. Corporate bond. It is debt security that is issued by a firm and sold to investors, wherein the company gets the capital it needs and in return the investor is paid a pre-established number of interest payments at either a fixed or variable interest rate. Government securities. They are investment products issued by both the central and state government of India in the form of bonds, treasury bills or notes. Treasury bills, also known as T-bills, are short-term debt instruments issued by the government of India and are presently issued in three tenures, namely 91 day, 182 day and 364 days. Commercial paper. It acts as the debt instrument to be used by large corporate companies for borrowing short-term monetary funds in the money market. Money market instruments in India. They are liquid with varying degree and can be traded in money market at a low cost. For example, treasury bills, commercial bills, repurchase agreements, commercial papers, certificate of deposit, bankers acceptance and money market mutual funds. Index funds. They are investment funds that follow a benchmark index such as Nifty in India and Nasdaq in the US. When you put money in an index fund, that cash is then used to invest in all the companies that make up the particular index, which gives you a more diverse portfolio than if you were buying individual stocks. Warren Buffett said, I just think that the best thing to do is buy 90% in S&P 500 index fund. So please invest in index funds. Below I have given you a screenshot of Nifty 50 in India and you can see since 2000 it has been only growing. Definitely it has its highs, lows and peaks, but as you can see it has grown from 1900 till 18,255. We have collected common questions from clients on mutual funds for you. The first question is, are mutual funds risky? And the answer goes, have you ever thought how banks make money? Every bank in India has got its own mutual fund, which is called as AMC, Asset Management Company. So these banks basically take the money from us in the form of FDs and put it into mutual funds. They generate a very good return out of it, which is in the range from 10 to 17%, and then they give it back to us at the rate of 5%. So, are mutual fund risky? You got the answer now. Second question, do mutual fund guarantee returns? Well, every form of investment comes with a certain amount of risk, and hence mutual fund also comes with a risk. But with experience, we know that mutual fund has given good amount of return if you invest it for a longer period of time. Okay. Question number 3. Are mutual funds liquid enough? Yes, they are very liquid. You can invest at any time and you can redeem at any time you wish. Question number 4. Is the mutual fund industry evolving in India? 101%. As we can see, the number of investor folios has gone up from 5.28 crores in 2016 to 12.02 crore in 2021, and on an average 11.23 lakh new folios are added every month in the last 5 years since 2016. But remember, one thing about mutual funds. Mutual funds are subject to market risk and hence read all the offer documents carefully before investing. That's all from my side. If you want to invest in mutual funds, please contact me on 7349701701. You can also email me at bodhifacilities@gmail.com for any queries or concern. Please don't forget to like, comment and subscribe to our YouTube channel as we are going to bring a series on mutual funds for you. If you need a video on a particular fund, please comment and we will happily make one for you. Thank you so much.